Thank you very much. Thank you very much indeed. It's a huge privilege to be here and to wish all of you at Triodos happy birthday. Happy birthday, Triodos. Happy birthday, those who work in the bank. Happy birthday, those who benefit from the loans that are given to worthwhile projects. Happy birthday, fellow investors. It's a privilege to be amongst you. I want to set a little bit of context for the work that Triodos does. And I believe that where Triodos sits in that context is at the moment absolutely unique. And my hope is that over the next 20 years, if I were to have a wish, a forecast, a scenario, it would be that in 20 years' time, Triodos is not so unique. You may have a few competitors snapping at your heels at that point to be the bank of choice in relation to sustainability and durability. And I'm sure that you will welcome that competition as you've welcomed the challenge of operating in a financial market which is sometimes robust in its defense against your own vision for what a financial market should be. I want to talk about a few of those things. I want to lay down some challenges. I want to throw out some examples. I want to invite you to a conversation about the future of our economy. And though one starts in a very simple place in a way with the dilemma that we live on a finite planet, that a continually increasing economy on a finite planet eventually comes up against its limits, and that the growth-based economy that we have at the moment certainly is simply unsustainable. And yet, the opposite of that, call it degrowth, décroissance in the much more palatable French, almost something you might want for breakfast. Décroissance is unstable in whichever language you speak it. A very simple dilemma. We've built an economy on a finite planet in which we are inherently reliant on growing and growing and growing. And as I suggested, although you start in a simple place with this rather simple dilemma, where it takes you when you begin to ask questions about it, why we got here, how we get out of it, who are we, human beings, in the middle of it, you find yourself asking, as Olivier suggested, deeper and deeper questions about the meaning of the economy, its place in our lives, and indeed our place, our idea, our sense of what prosperity is. And I'll touch on a few of those things. I want to start 5 years ago, just over 5 years ago. The past is another country, says the narrator in the 1970s film, The Go-Between. They do things differently there. And 5 years ago, we certainly did things differently. So differently that at a certain point, the whole thing came crashing down, of course. The 15th of September was the collapse of Lehman Brothers in 2008. A point that only a few economists actually saw coming. Economists are very clever people. I have a great deal of respect for them, for us, for me, sometimes. I have also alarming fears about the narrowness of the prevailing economic vision. And that economic vision failed to see exactly what had been created and what was about to fall to pieces on the 15th of September. Here's a very interesting quote. It is well enough that the people of this nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. Can you imagine who said that? It wasn't Peter Bloem, it wasn't Greenpeace, it wasn't Kofi Annan, it wasn't Gandhi, it wasn't any of the luminaries of a humane and sustainable society. Actually, it was a man called Henry Ford back in the 1930s. An understanding that the money system itself was somehow already engendering human injustice, social injustice, was inequitable. And the responsibility of bankers, the responsibility that bankers had for money itself, actually is a social good. And for the most part, that social good goes unrecognized, is unused, is unforeseen, is undirected, and created in the 15th of September 2008 chaos in its wake. That is the system that we have to deal with. Economists, amongst their virtues, are supposed to recognize the price of everything and the value of nothing, as the joke goes. It's not a very funny joke. This price of everything and the value of nothing changed around 10 years or so ago. If you look at the trend in my graph here, what you'll see is that it is largely, apart from a couple of shocks, a downward trend in the price of commodities. With some shocks in the world wars, the oil shocks in the 1970s, the trend in commodity prices looked like it was relentlessly coming downwards, and this pleased economists enormously. This was a sign of the success of our economy. It allowed us to neglect the wisdom, for example, of the limits to growth debate in the 1970s, and to suggest, as happened in a very famous bet between Julian Simon and Paul Ehrlich in the 1980s, that costs would just continue to come down and down and down. Paul Ehrlich argued that actually the price of this basket of commodities would be higher by the year 1990. Julian Simon reckoned that it would be lower. Julian Simon won the bet because at that point commodities were still coming down in price. Things looked exactly as economists would like them to look. The world was going in the right direction. We were becoming more and more efficient. Our economies were solving all of our problems. And yet, in 2000, just before the crisis, something very strange happened that economists had not foreseen. Prices of commodities, food, minerals, metals, fossil fuels in particular, began to rise sharply. And what you see there on the very right-hand side of my graph is the crisis was not the highest point in that change in commodity prices. The crisis did lead to, and to some extent was triggered by, a rise in commodity prices beyond anything that we had seen in the last 40 or 50 years. The price of oil reached $147 a barrel in July of 2008, just before the crisis. And after the crisis, prices did fall a little, as prices tend to do in a recession. But the most extraordinary thing is that that trend didn't go back down again. It doesn't look like we're in the world that we had before 2008. It looks like a different world. It looks like a world as Paul Ehrlich might have thought it would look, in which prices would actually go up for commodities, in which commodities would become scarcer, in which the conventional way of driving an economy through material throughput would become more and more difficult. The price of everything and the value of nothing. You never miss the, how does it go? The sun until it starts to snow. You never miss your lover till you let her go. And you let her go. It's a song for those who don't have teenage children. And so where we found ourselves after 2008 was a place where we wanted desperately to reclaim the idea of growth. But we also recognized that we had to do that in a greener way. We had to look for what is kindly called green growth. We had to look for a green growth economy in which we no longer trashed the climate, deforested the forests, denuded the oceans, ripped materials out of the ground and threw them into landfill sites with only a brief window of usefulness in between. We needed a different kind of economy, a different kind of growth. One of the problems we found ourselves is that the harder we chase this growth, the faster we chase this kind of greenness, actually the faster the economy itself moved around us. And so that for all the progress we made on renewable energy, on energy efficiency, on resource productivity, actually the growth in the economy over time swamped those advances faster than we could make them. And what I want to do, rather than showing you the evidence for that or talking about the detail of it, I want to talk a little bit about why that might be. I want to ask the question, if green growth is possible at all, is it possible in this kind of economic system, in the kind of economic system that we have? And to do that, and I apologize for this, I want to lead you through, as quickly as I can, what this system is, how it's supposed to work. If you like, it's Economics 101 5 minutes flat on a Sunday afternoon when it's raining outside and you have many things to think about. But I hope that what I can do is point out the salient features of this economy. It's an economy that works something like this. Firms produce goods for people, and people provide labor and capital to firms. That's called the circular flow of the economy. It works by firms giving income to people which they can spend on the goods and services. A fair exchange. It's really, at this point, a very simple relationship between two sets of people, one who make goods and services and the other who spend money on them. And as it turns out, it's the same group of people, more or less. So it's a way of organizing society. Perhaps the most important part of this society, though, is that we don't spend all our money. We save. We have a propensity to save. We have a propensity to put some money aside because we care about the future. And where we put that money is into a banking sector, a financial sector, which invests those savings. Now, in the system as it exists at the moment, mainly what happens to those savings is that they're invested in a couple of particular areas. We chase productivity. We want our productive processes to be more and more efficient. In particular, we chase labor productivity, trying to get our workers to do more, to produce more with each unit of time that they put into the labor year on year on year. So this investment in pursuit of labor productivity is one of the main driving features of this economy. It's a very interesting one in some ways because it brings down prices and that makes things more affordable. It also encourages us to buy more of those things. And in the process, you'll notice, those of you who like arithmetic, which I'm sure you all do, that if you're doing things more efficiently year on year with a given labor force, if each laborer can produce more and more goods each year, then unless the economy grows year on year, you have a problem. You're putting people out of work by chasing productivity. So here you see in my little diagram exactly why we're so hooked on growth. That if we can't grow in an economy chasing labor productivity, we're faced with higher unemployment. There's another really interesting thing that we do with this investment in the conventional model. And this was pointed out by Joseph Schumpeter in the 1930s. When he talked about innovation, a process of creative destruction. We're continually throwing over the old processes, continually throwing over the old products in favor of the new ones, the latest gadgets, the fastest cars, better communications. Our lives are actually, in some sense, ruled by this novelty because it isn't simply the aim of every enterprise to innovate and innovate and innovate and use its investments for innovative purposes. It turns out actually that novelty matters to us. The new is something that to some extent we all as human beings love. We crave novelty. Novelty is a language. Novelty is a language that allows others to know how important we are because we have those latest gadgets. We are dressed in the most recent fashion. We have a set of consumer goods that is a language that allows us to talk to other people, to communicate with each other. And this is a point where we begin to see actually that the system that we've created is inherently in us. It isn't simply something out there. It's something that we have to grapple with our own appetites for if we want to understand, and I would argue get beyond it. Of course, we don't always crave the new. One of the interesting things that happened in the crisis, in fact, is that people stopped going out and spending on their credit cards on the high street. They wanted instead to hunker down. They wanted to be safer. They wanted to think about the future. They cared more about security. John Maynard Keynes told us, in fact, that this is what always happens in a recession. He called it the paradox of thrift, because what people want to do in a recession is to save. But what politicians want you to do in a recession is to spend more and more and more. And in order to ensure that we spend more and more and more, of course, there's a host of advertisers, investors, politicians, business people, retailers out there trying to persuade us in very simple terms to spend money we don't have on things we don't need to create impressions that won't last on people we don't care about. It's an economy built, therefore, on credit and debt. It's an economy in which actually scandalous things are happening in ordinary people's lives who are being persuaded into debts that they can never pay off. by people who are simply chasing assets like the property that they live in. It's a scandalous place in which commercial credit is being given to operations with child labor in the supply chain and with degradative, environmentally destructive practices in the raw materials chain. And it's an economy, a financial economy, which is built fundamentally in the most recent years on a form of speculation that amounts to little more than casino gambling. It's a casino economy. And here, I just want to show you, this is the picture from the statistics in the UK, where each of those different parts of the financial economy sat over the last 15 years. And what you'll see here is the green line at the bottom is the investment in non-financial corporations. That, if you like, is the investment in the real economy. It's not anything like as green as we at Triodos would like it to be, but at least it's investment in productive capacity in the economy. The swathe in the middle, which has grown substantially over that period, is the consumer lending to households. But the big, most noticeable part of the data in my graph is this huge swathe of purple to red, which is the lending of financial corporations to financial corporations. This is a series of speculative activities in the price of commodities, in the price of property, in the price of derivatives, and it dominates the way in which the financial market worked up until the crash. And when the value of those assets began to fall because the people that were lent to could no longer repay the loans, then that was the point at which the market began to create complex financial derivatives that it sold on to other people with the hope that they would hide the fragility in the balance sheets. It didn't happen. 2008, Lehman Brothers, the 15th of September, was the date at which we realized that casino economy was damaging not just to the environment, not just to people's lives, but actually to its own stability. Consumer mortgages, I've talked about. At least mortgages are, in principle, secured on physical assets, on people's homes. But when those mortgages fail, when those debts fail, when people actually lose their homes, when their homes are taken over by credit companies with no morals whatsoever, this is a point at which that part of the financial market has stopped working too. And the real investment part, the bit at the bottom, the green bit, much as we would like this to be investment in real terms, in our own future, what it turns out to be in many cases is short-term, rent-seeking, chasing productivity bottles, depleting resources and degrading environments. This is a financial economy that is deeply dysfunctional and immoral. And it was all in pursuit of a kind of economy that must continue to grow. And it must continue to grow not just for our own appetites, but because of the system itself. Here is a very interesting quote from 1955 from a man called Victor Lebeau, who argued, and there's some dispute whether he was saying this was a good thing or a bad thing. I want to give him the credit, the benefit of doubt, and say that he was arguing it was a bad thing. Our enormously productive economy demands that we make consumption our way of life, that we convert the buying and use of goods into rituals, that we seek our spiritual satisfactions, our ego satisfactions in consumption itself. We need things consumed, burned up, worn out, replaced, and discarded at an ever-increasing pace. And we need that, why? Not for the benefit of people, but to keep a dysfunctional system going. It's probably true that our economists are the only people who really have this view. But the argument is that the system is good for us, that we, through our own evolutionary makeup, are selfish, novelty-seeking, acquisitive hedonists, and that our own individual pleasure is the thing that drives this system and makes it a success. And yet we've come to a point at which it is a almost complete failure. It has failed the climate, It has failed the poorest people in the world. It has failed the child labor in the supply chain. It's failed the stability of the financial market itself. So where does this idea come from, that we are simply pure, selfish, novelty-seeking hedonists? Does it have any basis in reality? Can you find a psychologist to support it? Can you find a sociologist? Can you ask ordinary people? If you go to church, would you hear it from the sermon? Can you find philosophers writing that human beings are purely selfish? The answer is an extraordinary no. And actually, when you begin to look at what philosophers say, at what artists say, at what writers say, at what religious people say, at what ordinary people say in the street about their own lives and about who they are, you find a much more complex picture. Now, I don't want to suggest that you'll find people telling you that we're all angels. Nobody really believes that we're all angels. Of course, we have a selfish component. But it's also clear that if we didn't have an other-regarding component, if we had no altruism within us, we would never have evolved in the way that we did in social groups. This is an insight from Shalom Schwartz, a psychologist, a social psychologist. And Schwartz also argues that this tension between self and other is mirrored by a tension between novelty-seeking, and tradition. Novelty is adaptive, was adaptive in fast-changing environments. And so it evolved in us naturally. But so did tradition and conservation, because without that stability, we would never have raised families, formed communities, created societies, brought together governments. These two tensions in the human psyche, in other words, are a better reflection of who we are than this simple idea that we are selfish, novelty-seeking consumers. And if you look at my diagram on the top right-hand side, this map of the human heart, if you like, you'll see those novelty-seeking, selfish components in us. But what you'll also notice is how systematically we have ignored the other three quadrants in the circle. And in other words, what I want to say here is this is an enormous opportunity, not just to create a new economy, not just to do things differently, but actually to be human beings, to create institutions that reflect who we are as human beings. And in the last few minutes of the presentation, I want to say how that can be translated into the building blocks of a green economy, the foundations for a truly resilient economy, a different place to be. Economy is, in one sense, about enterprise. Enterprise has been taken to be a profit maximization exercise that pays no attention to the material throughputs and the material damage that it creates. I believe there's another vision for enterprise. I want to think of enterprise as service. I want to think about enterprise as human beings organizing themselves in the service of others, providing the things that matter in society: nutrition, health, education, social care, renovation, refurbishment, relaxation, leisure, craft, culture, things that enrich the quality of our lives. Here is a sector of economic activity which has some peculiar characteristics. One, it can be quite resource light. It's not about stuff and the throughput of materials. It's about the time that we give to each other in service. And because it's about time, because it's about the time that people give in service, it is an employment-rich sector. It makes no sense to ask the teacher to teach bigger and bigger class sizes. It makes no sense to ask the doctor to see more and more patients in every hour. It makes no sense to ask the London Philharmonic Orchestra to play Beethoven's symphony faster and faster each year. The goals of labor productivity have to be shelved in favor of the quality of work and the care and the craft that the craftsmen put into their artifacts, that the artist puts into their creation. Here is a place, a vision for enterprise, for a new economy which is ecologically light and humanly rich. The employment implications of that are clear. It is possible within such an economy to create employment, to have an enriched working life. Rather than thinking of labor as a commodity that has to be excised from the workplace as much as possible, we think about people's time as the foundation for that workplace. And within such an economy, there is work to be had and labor to be employed. The most important thing, and of course it's the most important thing in relation to our discussion today, is the question of investment. Investment is key to this economy. Investment I like to think of as a relationship. It's the fundamental relationship in economics, and it's the relationship between the present and the future. Investment is about protecting, maintaining, building up the assets on which our future prosperity depends. And this, of course, as I will show in a minute, creates a different ecology in the financial sector. It demands a sense of slow, patient capital over the fast speculative gambling that we saw in the past. It also demands, and I won't have time to talk much about this in the presentation, but perhaps we can touch on it afterwards, it demands a different approach to money. It demands a return to Henry Ford's concern about a banking system that nobody could understand, in which social good had been appropriated for the purposes of profit by a minority and was being misused. And it has to be said as bluntly as that. The responsibility for the social good of money has been misused by the vast majority of the financial sector. And that is a key element in a transition for a green economy. A green investment portfolio will be very familiar to you. Olivier mentioned some of these things. Green technologies, of course, will bring very good returns, will actually bring profit in many cases. Infrastructure can also be profitable and certainly has social returns. We need a decent public transport system. We need low-carbon buildings. We need community spaces where we can, in fact, engage with one another as human beings rather than as consumers, in a world in which prosperity is something bigger than material. We also need to invest in ecology itself. The biggest assets, the most important assets, the ones on which future generations and polar bears depend, are the ecological assets, the forests, the habitats, the soils, the wetlands, the oceans. And investing in those assets is a key part of what the new investment portfolio has to be. And of course, we must invest in those services which I have argued are at the heart of enterprise in the new economy. A fantastic, an exciting, a human portfolio for a different kind of economy. And Triodos Bank, of course, is situated already in some of those spaces. Green technologies. The one thing we know about green technologies is that they're increasing. Here's a nice example of protecting ecological assets. This is from the Savory Institute, and it's a fantastic example of a small innovation in livestock management, which allows you, in fact, to protect, to restore grasslands simply by a different way of managing your livestock on those lands. Alan Savory has given a wonderful TED talk about that to those who might be interested. Here's another kind of investment in keeping oil in the ground. The Yasuni project in Ecuador, the government of Ecuador offered an investment activity to ordinary people to invest in the forest, to protect the forest rather than to exploit it, and promised that the government of Ecuador would match pound for pound, dollar for dollar, that investment in practice. Those investors are not seeing financial returns. So why would they do it? Is it really investment? They see social returns, they see ecological returns. And a part of what we have to do within this sector is to recognize that if we want to encourage this kind of investment, those returns must be realizable, they must be protected. It mustn't be the case that those who do good in terms of saving their money in the right place are punished by a casino economy that creates speculative gambling that undermines the value of money itself. Here is a huge challenge, and I want to come back to it briefly. Money has to change. Money in a green economy cannot be this private commodity beholden to the whims and the greed of a financial sector running amok. And one of the most promising things from my work since Prosperity Without Growth has been collecting together some of the examples, some of the places where this change can occur. Very, very small scale changes in peer-to-peer lending, for example, in community banks and community bonds. People saving money at the community level to invest in the community for the community. Changes in institutional investors, small and large, some of them just about governance, governing better, so that the supply chains are not so unjust, so that the impacts are not so devastating. Screening out projects which have negative impact. But more importantly, perhaps, investing for good, saying that no dollar anywhere, no euro anywhere is invested if it isn't investing in this transition. Impact investment, it's sometimes called. And then finally, of course, at the macroeconomy level, you have to make changes. You can't have this kind of investment as the centerpiece of the financial economy without changes at the macro level. You need a sense of responsibility embedded in financial regulation. You need clear fiduciary duties to shareholders that maximize the long term rather than the short term. You can think about transaction taxes, for example, which slow down the rate at which commodities are traded. You can think about the way in which money itself is spent into the economy. You can even ask the government itself to take some responsibility for the social good that money is, instead of handing over the power of money creation to the financial sector in its entirety. Governments can and should, must adopt a sovereign right to protect the social good of money. And there is one example, I'll come to it in a minute, which shows exactly how that might be done with an extraordinary pedigree. Let me just run very quickly through these examples. Peer-to-peer lending, this is one of my favorite examples of a small community of investors investing in a portfolio of projects, deciding amongst themselves which projects they want to invest in. It's coordinated by this organization called SPEAR, and it has produced good, solid, not massively speculative returns on capital, but decent returns to ordinary people's savings. Here is another example, shared interest. Shared interest is a financial vehicle, the financial vehicle that sits behind fair trade, the fair trade label. Without shared interest, which distributes dividends fairly along the supply chain, there would be no fair trade goods. Financial innovation at its best. Here is an example that dates back to the 1930s. This is the Wir Bank. Wir in Germany means we, and it was used quite deliberately to express the collective intent of a group of business peoples trying to survive the crisis in the 1930s, the crisis, the depression. And the way in which they did that was to create a collective in which essentially what they formed was an alternative currency. A currency that was no longer dependent on the vagaries of the financial markets, but which enabled peer-to-peer lending to invest in peer-to-peer businesses and create solidity in the face of chaos. Wehrbank has, from a few hundreds of business people, is now still a going concern in Switzerland. Here is the example I pointed to in relation to money. Of course, we sitting here, ordinary investors, even in an innovative project like Triodos, thinking about the financial sector cannot expect to change the whole thing. What can we do about the money system itself? And yet the extraordinary thing is that there are things to do. In the 1930s, again, something called the Chicago Plan was put forward. And this was a plan essentially for 100% reserve banking, in which every credit made in the banking system had to be backed by reserves in the central bank. And although this is quite a radical rethinking, it has some extraordinary proponents. Irving Fisher was the first person to put forward this plan. He was a Nobel Prize-winning economist from the 1930s. Milton Friedman, unbelievably, free market advocate of the most torrid kind in some ways, believed that the instability of the financial system could only be tamed by tempering the 100% reserve requirement, the fractional reserve requirement in the financial sector. And this plan, it's argued, would eliminate bank runs. It would lead to instantaneous reductions in the levels of debt because the money creation no longer requires simultaneous debt creation. This is a really important feature to bring into a financial system. Who are the proponents of this now? Again, it isn't the radicals, it isn't the leftists, it isn't the Marxists. Actually, this paper, the Chicago Plan Revisited, was published last year by the International Monetary Fund, the angels of the new economy. And then here, finally, is a bank. I'm not sure where they are, what they're doing, really, where they live, but I happened to get a picture along the way, and I thought I'd show it in this particular presentation. It has been a privilege and a pleasure to stand here and talk to you on your 20th birthday. I believe that what Triodos does, where Triodos sits, is right at the heart of a different kind of vision, not just of the financial sector, but of the economy as a whole, not just of the economy, but of society itself, not just of society, but of who we are as human beings. Because for us, prosperity at the end of the day was never about dollars. It was never about material stuff. Of course, those things matter, that we need to provide and provision for ourselves, but prosperity transcends material concerns. It goes beyond the immediate luxuries of materialism and consumerism. It is about the love of our families, the strength of our friendships, the solidarity of our communities. It's about the integrity of our relationship with the future and the integrity of our relationship to the environment. Prosperity, as Zia Sardar once said, is a condition that can only be conceived to include obligations and responsibilities to other people and to polar bears, it seems. Thank you very much for listening, and I look forward to the conversation with Olivia.